Okay, Chapter 11. Chapter 11 is we're going to talk about the equity section of your balance sheet and how to analyze that, how transactions are handled in the equity section. Remember, and we've talked about this when we were talking about bonds, equity is a financing function. Companies go out and they sell stock to pull together cash to start the company. And oftentimes they'll go out and issue more stock as a way to bring more money into the company. And they do that instead of borrowing money from a bank or issuing bonds. So it's a component of financing. If you look in the cash flow statement, activities surrounding stock sales or repurchases are a financing activity. Okay? We haven't talked about this since the beginning of class, so I want to brush on a couple of things since we're talking about stock and ownership. We're talking about corporations. They're the ones who are selling stock to finance themselves. A corporation is treated as a legal entity. It is treated as a person, just like you or I, and because of that, it can do some things. It has some rights. It can be sued. It can enter into contracts. It can sue others. It can own things. It can own assets, just like you or I could. Remember, if you go out and start a company on your own, what's called a sole proprietor, and you die, the company's over. Corporation, one of the advantages is, you have many owners, and if one of them dies or sells their shares, the company doesn't come to an end. It continues to exist. And it's easy to go out and sell those shares. They're traded on a stock exchange. They're traded on a stock exchange. It's easy for you to call up your broker and sell your shares or buy new ones. So it's easy to transfer your ownership, and you get some element you get limited liability. If the company is sued or goes out of business, the lenders to the company can't come and sue you personally. Your total exposure is limited to how much you paid for the stock. So the worst that can happen is the stock value goes to zero and you're out that money. If you are a sole proprietor, if you have your own company, and you borrow money from the bank, and the company can't repay it, the bank can come to you and ask you to repay it for the company. So corporations don't have that problem. Good? Questions? All right. Let's dive into what all that means a little bit more in depth than we have in the past. If you're an owner of shares of a company, stock, what rights do you have? You don't get to run the company, but you do have the right to vote at what's called a shareholders meeting, and they vote on major issues for the company. Primarily, who's going to be on the board of directors. And the board of directors is a small group who oversees the management of the company. And they also hire the CEO of the company. So the CEO works for the board. The board is elected by the shareholders. And then the CEO goes out and hires all the people that are going to work for him and make the company run. So you get the right to vote. You get a right to any dividends, if any are declared and paid out of the company. What are dividends? Anybody? It's a distribution of the earnings and profits of the company. So if the company's making money, a lot of times they'll declare a dividend and pay it out to the shareholders. It's kind of a return on your investment. If you want to compare it to a bank account, it's like earning interest on your bank account, right? If the company liquidates, you get a piece of whatever's left after they liquidate. So if the company sells all its assets and converts it to cash, pays off all its debts, whatever's left over, the shareholders get to split it up. Okay? Yes, ma'am.
I have a question about the voting. Who really votes? Is it usually the people who have most of the shares? Because I would imagine if you just have a few...
Everybody can vote.
They can, but...
They will send out a notice that there's going to be a shareholders meeting, and you have every right to go to the shareholders meeting, show up, and vote for how many ever shares of stock you own. More commonly, what happens is people will give what's called a proxy to someone else. I'm giving you the authority to vote my shares for me at the meeting. So you can pull a bunch of investors' votes together and send one person to vote them all. But you've got to also understand that the people who own a lot of shares get more votes than the people who only own a few shares. Okay? Good?
Yeah, I was just wondering, do most people who don't own very much stock, do they even bother?
A lot of people don't bother. They get the notice in the mail and they don't fill out the proxy and send it back. So, yes, ma'am?
So all of those things apply, like if I go to Scottrade tomorrow and buy like shares in company XYZ, then all of those things, like I'll get dividends and I'll get
If the company
distribution of assets if they liquidate.
If the company declares a dividend, yes, you would get
This is in addition to like whatever money I make just through my investing like, on the stock market.
Yes, and this is going to come up later, but there's reasons why people invest in these companies. There's two types of return on your investment. One is you get the increase in stock price. So if you buy it at 10 and the value goes up to 15, you've made money, right? If you sell it, right. And a lot of people will buy shares counting on there being this increase in value or stock appreciation. The other extreme is some companies, especially high-tech or new companies, will tell you right up front, we're not going to pay out any dividends. We're going to take all profits and reinvest them in the company to make it grow. So you're counting entirely on that stock appreciation. On the far other extreme, you get people who will buy a stock strictly because they want to make sure they get the dividend from it. And this is more of an old school thought. So you have to think in terms of like utility companies, like PG&E. Some people will go out and buy the stock of a utility because you know every year for the last 60 years it's paid out X dividend per share every year and it never misses. So it's kind of like guaranteed income. So you get, retired people who will invest $300,000 or whatever in PG&E and they know that they're going to get $3,000 a quarter or something. The checks just come in the mail. And they're not counting on any stock price appreciation, just the dividend part of it. So that's the two extremes in investing. And most people are looking for some combination of the two, somewhere in the middle. Okay? Other questions? All right. Here's what I was just talking about. The stockholders get to vote for the board of directors. Board of directors hires the president or the CEO. This guy works for them. And he goes out and hires all of the management of the company and they go run the company. Okay? This guy can get fired by these guys. Everybody else can get fired by the president. Yeah. Okay. So, because it all sounds so simple, let's throw in a couple of twists. Okay? Are you aimed too high? Okay. Let's throw in some twists. There are a couple of different stock issues I want to talk about. Issues as in concepts. When a company forms, they go down to the state and they file with the Secretary of State saying, we want to form a corporation, here's what it's going to be called, here's what business we're going to be in, and we want to be able to issue 10 million shares of stock. They'll pick some number, 100 million shares, whatever the number is, and they have the right to then go out and sell that many shares on an exchange to raise the money to start the company and run it. Just because you say that we want to be able to issue 10 million shares of stock, that doesn't mean you're going to sell them all. But whatever that number is, the state has authorized you to sell that many shares, up to that many shares of stock. So if they're sold out to the public, that's referred to as issued. And let's say they only issue 1 million shares of stock out of the 10 million. The other 9 million are what are called unissued. They've never been sold out to the public. Okay? So that's the first concept, issued and unissued.
Unissued has never been sold.
Yeah. Authorized is the whole 10 million. Good? Questions? All right. Now, there's one more little distinction that I want to make. The company can go out and sell that 1 million shares of stock. They're issued. And then in your work on your projects, has anybody come across what's called Treasury Stock or a stock buyback where the company's buying up its own stock? Okay. When a company buys back its own stock, those then become what are called treasury shares, treasury stock. So if the company issued 1 million shares and then bought back 100,000, you'd have 900,000 outstanding and 100,000 treasury stock. Treasury stock gets no voting rights. No one owns it. They don't get dividends. They just kind of go into limbo. Okay? Companies do this because, well, there's a number of reasons. A lot of times, the CEO and the management team will have stock options or be compensated through some form of stock. And the company needs to own these shares to be able to give it to them. Okay? The other thing is, remember your earnings per share ratio? If I don't increase earnings, but I decrease the number of shares, my earnings per share ratio goes which way? Up. And that's good or bad? Good. Okay? Because it will drive the stock price higher. So companies will sometimes do this when they have extra cash to drive their stock price up, which helps them get their bonus, even though they didn't make more money. See the trick? Okay.
Now, how some of them they get the stock options.
Right.
Wouldn't they be able to get it from the issued shares
You could.
instead of getting?
You could. But this is fairly common, so I want you to understand it's out there. Okay?
So, well, the main reason would be just for them to raise the earnings per share.
Or to come up with this because they don't want to go issue those. There's some effort involved in issuing those. Okay?
It's easier to reissue treasury.
It's easier. I'm just buying and selling stock. I'm just an investor on the stock exchange at that point as opposed to jumping through these other hoops. Right? It's really easy to do. Okay? Yes?
So if you're looking at investing in a stock that has treasury shares, so it doesn't skew the results, I assume you should take the treasury shares out and then do your ratio for that extraction.
Well, remember earnings per share is net income divided by average shares outstanding. Are these shares outstanding? No. You're limited to just this. Okay? So you are pulling them out of the calculation.
So why does it affect the ratio?
Why does it? Hang on. Let's do this. So let's say you have $100,000 in net income and you have 10,000 shares of stock. My earnings per share is? Anybody? 10. I'm making $10 a share, which is phenomenal, by the way. I made my company good. So let's change this a little bit. Instead of having 10,000 shares outstanding, we only have 8,000 because we bought back 2,000 shares. What's 100,000 divided by 8? Anybody? I need a calculator for this. It's not an easy round number. It's 12 what?
12,500.
1250 per share?
12,500.
100,000 divided by 8,000?
Oh, 8,000, excuse me.
Okay. It's 1250 a share. So my earnings per share just went up by 25%. And you go, big deal, right? Well, the bigger the better. And stock, the most common thing that is disclosed out there in the real world, what's the stock trading for today? But what earnings per share is X. Everybody focuses on earnings per share. And stock typically trades at a multiple of earnings per share. 20 times earnings per share, 18 times earnings per share, whatever it is. So the bigger this number is, if the stock trades at 20 times that, the bigger it is, the better off you are. So you can drive your stock price up by doing this. Okay? Because you're spreading the same net income over fewer shareholders.
But if you declare a dividend, wouldn't the company be paying more?
If you declare a dividend, you're paying it to fewer people. They each get more dollars per share. Good? Because the other 2,000 shares of Treasury stock, they don't get a dividend. They don't get any.
Fewer shares out there, the better for the investor.
Correct. Okay?
So why wouldn't the company buy out
I can't hear you.
why wouldn't the company buy out their unissued unissued?
Why would you not do this?
Yeah.
Maybe you don't have the cash to do it. You need the money to invest in the company to grow. Okay. Good? Yes.
So you said that you have companies get treasury shares when they buy them back.
Yes.
And so what happens to those shares?
The company buys them and they own them and they sit in a treasury share stock. Treasury stock account on the balance sheet. In the equity section as a reduction of equity. And that's it. And they just sit there. Okay? Until they decide they're going to sell them. Okay?
So they can sell them?
Anytime they want. You can buy them and sell them on the stock exchange, so can the company. Okay? Because they're a person, they're treated as a person. They can go buy and sell assets just like anyone else.
If the company's doing really well, is that usually when they can write them back?
Yeah, but there will be a big announcement coming out of the board meetings saying, hey, we're going to make this stock buyback and we're going to offer people X number of dollars and our goal is to buy back this many shares and we're committing $30 million to this program, blah, blah, blah. They'll tell everybody all about what they're doing. And as soon as that announcement comes out, the stock price usually goes up a little bit. Are you level?
More or less.
More or less. Yeah, I'd prefer more.
So when they go back to treasury shares, are they treated the same as an outstanding share?
When who sells them back?
When the company sells them back?
Oh, yeah, if they take their treasury shares and sell them back out to the public, they go right back up into this category and they're treated just the same. We're going to go through the examples of how you record the transactions in a minute. Okay? Yes.
So, do you kind of not want to sell yours back to the company, send your dividends?
Well, they announce how much they're willing to pay for the shares. And usually there's a little bit of premium over the market. So you have to decide, are you willing to accept that premium over market and convert it back to cash or not? Do you think that the share value will go up more than the premium they're offering or not? Yeah. Good. So here's our old earnings per share formula. This is really what we were just talking about. Yeah, it's the single most widely reported financial ratio. You hear people, if you ever listen to the business news, they talk about earnings per share. If you read through the financial information in the newspaper, they talk about earnings per share. The higher the better. Good? All right, here's some comparisons for your project. Remember, you can compare your own company through time. Are they doing better than they were in the past? Is earnings per share increasing or is it decreasing? And how are they looking compared to their competitors? All right? So you would think Whole Foods compared to Safeway back in 2009 which stock would trade at a higher price? You would think, right? Barring some really bad news about Safeway going on at the time. You know, if news came out that said they've manipulated their financial statements, no one believes that number anymore, right? So what's it worth? Who knows? If. That's a big if. I'm not saying it happened. Okay? All right. Stockholders' equity is, I want you to remember this. We talked about it early on. Contributed capital, which is the stock, and retained earnings. Somebody, what's retained earnings? Retained earnings is not the dividends. It's what?
The amount of net income reinvested in
Hold it one at a time.
Money that's reinvested.
Money, no.
the amount of the net income that's reinvested.
It's the accumulated earnings and profits, i.e. net income, that the company's had since the beginning of time. So net income drives this up, and dividends reduces it. So if there's a dividend declared, you reduce it. Jim?
Is an owner's law the same as a dividend in a sole proprietorship, for instance?
They are very different animals, but in a lot of ways you can treat them the same. Okay? And we'll go through dividends here in a minute, but an owner can walk in and say, I want to take money out of the company. A dividend, there has to be a resolution from the board of directors saying we're going to declare a dividend based on current earnings or some other factor. You know, they liquidate a segment of the company. We're going to declare a dividend and we're going to pay it. All right, so one guy doesn't have say on this unless he owns 51% of the company. Yes, ma'am.
I just have a question. Going back to like the issued stock and stuff, how is there, one of my companies has more outstanding stock than issued stock. And I noticed that when I was doing the last journal, and I didn't understand how that could be.
More outstanding than issued?
Yeah. Like they have like the authorized, the total number of authorized shares, and then they have the number of issued shares and the number of outstanding shares, and the outstanding number of shares is more than the issued number of shares.
Let's look at that at break.
Okay.
Okay?
Okay.
I'm going, hang on a second. Yeah.
Stock split?
Yeah, but it would increase the number of issued in proportion, so, okay. All right. Yes, sir.
I mean, kind of sort of similar to her point. I mean, because it seems like for her there'd have to be almost unauthorized shares almost. I mean, what would an authorized share be?
Authorized is the total number.
Unauthorized.
Unauthorized. There can't be unauthorized shares.
Right, okay.
Okay.
So,
There just can't be.
what do shares
If you go to the
be?
Secretary of State, you say, we want to have the authority to issue 10 million shares of stock. And they go, okay, fine. You can't issue more than 10 million, but you don't have to issue all 10 million. Okay? All right. So that's the retained earnings side of things. It's accumulated earnings and profits, less dividends paid over time. The contributed capital section is broken down into two parts. It's the common stock. And have we talked about par value for common stock before? The par value of the common stock is recorded, and the capital paid, the money that's paid for the shares above what the par value is, goes in capital in excess of par. Two separate accounts on your general ledger, but they are both components of contributed capital. Good? I think it was something we covered earlier when we were doing balance sheets, right? Good. Just a reminder. Yes?
Can you explain why they're separate, or just?
Yes, because you're tracking how much was paid. You're tracking you're tracking the par value and how much was contributed before that. And this number is going to vary. So this number kind of ties you to a number of shares that were issued. Sort of thing.
When I was reading, I remember the par value was given to help creditors, or to
Yeah, but the par value, a lot of stock is issued with like a penny for par value or $1. Well, even at the IPO, they're going to expect the stock to sell for some higher number.
But wasn't that supposed to protect the creditors in case something happened with the company they couldn't?
Yeah, it was originally designed for
Is
that.
that why they were separated like that? Is that what that was?
It's part of it, yeah. Yes.
If par value has no material relevance to the stock, why even include this?
Some states don't require you to have a par value, so some stock has 0 par value.
So like California, for instance, why would you include it?
Well, again, it goes back to, some older constructs, and so it was required as part of the law. Some states have a minimum capital requirement. The company has to have a minimum amount of money invested in it, and it's not allowed to go below that. I can't name a state off the top of my head, but I know if you form a corporation in Mexico, there is a minimum capital requirement that you have to invest X dollars in it to start, and it must always stay above that.
I just say, answer my question, one possibility is, just from a legal viewpoint, you have to have an adequate capitalization.
Correct.
A corporation, so that may be answer my question.
Yeah, that's part of it. You have to have, they set a minimum capital requirement so they know you have enough money to actually operate a company. Okay? Anything else? Going, gone. Okay. So there's a couple of different kinds of stock. There's different potentials. The one that we are all used to hearing and seeing and talking about is what's called common stock. The initial stock that is sold for a company is typically common stock. These are the shareholders who have voting rights, right to dividends, things like that. Very cut and dry. Dividend is declared by the board of directors. However, because equity is a form of financing, companies will oftentimes issue a different class of stock, and they're called preferred stock. And typically, because it's a form of financing to get people to invest in preferred stock, they change the rights. These guys sometimes don't get a vote. They don't have a right to vote, but they get the right to the dividends first. So if there are any dividends declared, these guys get it first before the common stockholders do. And we'll talk about that a little bit more as we go on here. Here's where we were talking about par value being, some nominal value that is the minimum legal capital to keep the company afloat. Okay? And some states don't require it, so you do see shares with 0. You see a lot of shares that have stated par value of a penny or $1, things like that. So it varies from authority to authority. One thing I want to point out, because a lot of students will do this on a test, par value is the value that is stated on the shares. It's like a coupon. This piece of paper is worth a penny. What's market value? We have no idea based on that par value. They are not the same. They are not connected. Okay? So you could sell it for, $500 a share on the open market, but the par value is $1. Okay? So just remember. All right, everybody's heard of the term IPO, right? Initial public offering. Good? Everybody's heard of that. An IPO is where a company will go out and make that initial sale of stock. It's the first time they're selling shares. They've had to jump through all these hoops with the SEC. So when you have an IPO, it's the first time you're selling stock. Those become not only authorized, but they now become issued. So you'll see it in financial statements. The company now has 1 million shares authorized and issued. Okay? Subsequent sales of stock are referred to as a seasoned new issue. So notice new, these are shares that have never been sold before. So when you go out and decide we're going to sell that second 1 million shares so we can go open some new stores, it's a seasoned new issue. And that's the first time those shares have been sold to the public. They're not treasury shares, but it's not the IPO, initial public offering. Good? Yes, ma'am.
You answered my question.
Okay. Okay. So let's do some examples real quick. Just as a reminder, we kind of hit on these earlier in the semester. Here we've got a company, Kroger. Anybody heard of them? If you're from back east, you've heard of them. Yeah. Grocery store chain. Yes. Big one. They're going to issue 100,000 shares of stock for $20 a share. The par value, the stated value on the shares, is $1. Okay? So how much cash are they going to get? 100,000 times 20 is $2 million. So you're going to debit cash because you're getting cash. Cash increases, $2 million. Common stock, remember we only recorded at the par value, 100,000 times $1. You get a debit to common stock for 100,000. All the rest of it is capital paid in excess of par. Okay? So that $1.9 million is a credit to capital paid in excess of par. And remember that your common stock and your capital paid in excess are credits because they're in the equity section of the balance sheet. Yes, sir.
So capital in excess is the same thing as additional paid in capital, right?
Correct. Additional paid in capital was the term that I learned long ago. This book is using capital
So should we
in excess.
start to use that now? Or would it-
I'm okay using them interchangeably. Okay? Other questions? Moving on. So this is what the company records when it sells those shares. That's your initial public offering or your seasoned new offering. Okay? Now, once those shares are out in the wild, out in the real world, if you go sell yours to you, does the company care what goes on in the market, on the stock exchange? No. There is no entry if one person sells their shares to somebody else at a higher, lower price, whatever. There's no entry on the company's part. Good? Simple. All right. Sometimes we have these issues where employees get stock options, or part of their compensation is the stock itself. You know, if you meet certain targets, you get 1,000 shares of stock, whatever it is. You know, and your goal is that price keeps going up, so you're trying to drive that, so you earn more. That's a form of employee compensation. There's stock options. A lot of times they won't want to issue those new shares. What they do is they go out and buy shares off the open market, and they just end up giving those to the employee. And those become what's called treasury stock, like we were talking about earlier. Treasury stock is always recorded at cost. So the whole par value thing kind of goes out the window here. So for example, Kroger went and bought 100,000 shares of their own stock at $20 a share. Fair enough, seems reasonable. It's $2 million. Cash goes out, credit, $2 million. Treasury stock is a debit for $2 million. Notice it's a debit. It's a contra account in your equity section. It's not listed as an asset because it's your own stock. If we bought somebody else's stock, it would be an asset on the balance sheet. But this is a reduction of the stockholders' equity. Okay? Follow me so far? Okay. And it's done at actual cost. No relation to par value whatsoever. Good? Because that's our cost. And this, what you did is you took stockholders' equity and I bought the stock back, so I'm reducing my stockholders' equity by whatever it cost me. I'm not using it as an investment, or I'm not using any other type of financing. I'm just reducing my level of financing through stock by that many dollars. It's sheer dollars. Okay? Yes, ma'am.
For a company to buy back their own stock to create treasury stock, does that mean that all of their authorized shares are already outstanding? Would
No,
they do that?
not necessarily.
So why would they buy back their own stock if they still have available shares to issue?
Well, they may want to, it's easier to just buy them back and instead of issuing new shares.
Is it easier?
Yeah.
Does it make a difference?
You could also be trying to
Well, yeah,
drive your earnings per share. Yeah. I mean, there's lots of reasons to do it. And if you have a employee stock option plan that, you know, is a quarterly incentive sort of thing, you'd be doing it all the time. And do you want to issue new shares all the time, or just go to the market and buy some, right? So path of least resistance, lowest cost. Okay? So,
Quick question about
sir.
that. Why it seems like an oxymoron to have a positive accumulated stock equity, but then you have a negative stock equity. How could that be?
It's,
How do you get that?
remember, it's like an asset with its accumulated depreciation. It's a contra account, and you need to net the two against each other to come up with your true ending balance.
Okay, all right.
Okay?
Got it. I got it.
Okay. All right, so here's where the fun starts. We bought these shares back for $2 million, and now we're going to turn around and we're going to resell them. The company says, hey, I need to raise some cash for something, pay off some debt. Let's go sell those treasury shares. Good? Good idea. Look, the market's gone up. We can sell them for $30 a piece instead of 20. We only paid 20. We can sell them for 30. Life is good for us. When you sell 10,000 shares at $30, you get $300,000 in cash. Treasury stock, what did we pay for those? $20 a piece. 20 times 10,000 is 200. So your treasury stock account goes down by what you paid for them. And the rest goes capital in excess. Okay? So again, we're now utilizing the capital in excess because we've sold treasury stock for more than we paid for it. If we sold it for less, what do you think would happen? Take a stab at it, anybody. What?
The treasury stock would stay the same, the capital in excess.
Would you have a loss? You'd have a debit there. You'd have a reduction. Because it's financing. Okay? Okay. There was a hand over here. Yes?
So the whole like buying back your stock and then reselling it, like this whole treasury stock thing, is it just like anyone going to like, you know, and just buying
It's just
it?
like if you went and tried to buy it on the stock exchange.
Yeah.
Yeah.
It's exactly, oh, okay.
Except we're recording it slightly different when we sell it, if we sell it for more or less.
Yeah,
Okay?
yeah, but the actual like action is the same.
Correct. Yes. Yes, ma'am.
What about for like Dell? Didn't they buy back all their stock and then they went private?
They went private, yes.
Okay, so if they were to be like, all right, I want to start selling these again, would it be that whole IPO thing where it'd be like first time, brand new?
Yes. And that's because of the SEC reporting requirements. So by going private, you don't have to have those quarterly financials or audited financials that go out every year. You can kind of keep your information secret. So I'm sure they're not jumping through all those hoops. So if they want to go out and sell stock to raise capital, it's an IPO again. Okay? Lots of hands here. Yes?
So this example is them selling their previously acquired treasury stock.
Yeah. We bought them for 20. We're selling them for 30. Here's how you deal with it.
But the share amounts are different. You bought them back, you reissued, but the share amounts are different, so then the dollar amounts are different. How do you?
I'm not sure I understand the question. You keep track of every time, if you bought stock back, one day you bought them at 20, the next day you bought them at 21, the next day you bought them at 25. You would keep track of that and you would do a, first in, first out, specific identification sort of, okay? Yes?
Now, in regards to her question about Dell, if they wanted to reissue and they had to do the IPO, would they base it on what their stock price was worth when they went private, or would they do a completely new estimate?
So if I bought all the stock back at 20 bucks a share, and we operated as a private company for 5 years, and we turned around and did an IPO, what's the stock worth? It depends on how many shares. Has the company grown? Has it shrunk? Is the market doing well? You're going to make a whole new estimate on what that value is going to be, because too many variables have changed. Okay? Yes, ladies first.
So if we sold that stock at $10 a share instead of $30 a share, then cash would be, what, 100,000?
Correct.
And Treasury stock would still be 200,000?
Yes, ma'am.
And then capital in excess would be a debit of 100,000?
Yes, ma'am.
Okay.
I guess I'm just right outside the scope. Why would that be considered insider trading? They know when they're traded low, and they know when a new product's coming in, they get high. How come that's not? I assume that must be regulated. That just seems wrong.
But the objective is not to make a profit. The objective is to raise capital or pull shares off the market based on having extra cash. Okay?
Nice consequence, though.
It can be. I'm not really sure how to answer that question off the top of my head. In the same vein, when they do an IPO, they have to disclose everything, and that's part of the SEC filing. You're disclosing everything that has a material effect on that market value. So theoretically, if they're going to sell this stock, they're disclosing all this information in the quarterly 10Qs and things like that.
Right.
So at that point, is it really insider trading?
You have Apple, Steve Jobs, buy back Treasury stock before the iPhone 4. Okay? And all of a sudden, after the iPhone 5, they sell all the Treasury stock. They just make a tremendous amount of money for Apple.
Okay.
And they're insiders. They know what's happening. They know when their stock
Well,
goes up or down.
Steve Jobs isn't really an insider anymore.
No, been part of the i4.
Yeah, but all the things that Apple's come up with, yeah, they might somehow have contact with him, but I'm not sure of that. Okay? So, all right, are we good? Lots of good questions. Moving on. All right, dividends. Now, remember, one of the key differences in financing methods, if you borrow money, you have to pay the interest. It's required. You have to pay it. On the other hand, if you're financing through stock, you don't have to pay a dividend. If you have a bad year and you don't have enough cash, you don't declare a dividend, right? But dividends are declared by the board of directors. Once they're declared, we're going to record them on the books of the company as a liability. We've now made a promise to pay money out. Typically, there are requirements from the state that you incorporate in that you can't declare a dividend if you don't have enough cash to pay it, or you don't have any earnings. If you don't have any retained earnings built up, you can't declare a dividend. Okay? So there's several different steps in a dividend. One, the board gets together and they say, hey, we made some money, let's declare a dividend. That's the date of declaration. Okay? And when that day comes, notice we're going to debit retained earnings and reduce retained earnings, because that's where it's going to come from, and we put it in this liability account called dividends payable. We've made this promise to pay. Debit and credit. Good? Simple, straightforward. And that's at the date that they declare the dividend. It's usually the date of the board meeting. Not board meeting, the shareholders meeting. Okay? Or if it's done at a board meeting. Then there's this great date called the date of record. And the date of record is, let's go back to the board. They say, we're going to declare a dividend of $100,000 payable to shareholders who own stock on a date. And that's the date of record. So you have to own the shares on that date. If you sell your shares the day before, you don't get the dividend, the next guy does. Okay? If you buy the shares the day before, you get the dividend, not the last guy. And then the next step is, we declare a dividend today. that's payable to owners on the date of record, and we're going to make the cash payment at some point after the date of record. So they can figure out who they're going to send the money to, right? They figure out how much on the date of declaration, who to on the date of record, and they make the payment on the date of payment. 3 separate dates. So on the date of record, do you have to make an entry? No, because it was made when you declared the dividend and you recorded the liability. On the date of payment, we're going to say goodbye to our cash. So we're going to credit cash and it goes down. And we're going to liquidate that liability. So we debit the liability to make it go down. Simple, straightforward. Good? Yes, no, maybe? Okay. I agree.